All right, perfect. First live session here for the spring enrollment as well. All right, so we went over the draw on liquidity, which was, again, mainly order flow, mainly PD rays, seeing through those PD rays. And by dissecting everything and by them marking out every single PD ray, we got a better understanding of where we can potentially move towards. We used ES as an example. I want to go over multiple examples today as well. But right here, if we take a look at ES, we were talking about the daily fair value gap, which at that moment in time, at the moment in time of that video being created, it was not a daily fair value gap just yet, but it was in the making, so I already used it for the example's sake. Now, then we also had the previous day low right there, which currently is not a relevant PD ray anymore. You could use the order block right there. There was also a great question. I saw that just now. I will go over the Discord questions as well later on, just in the Discord itself. But I saw a question, why do we need to have a fair value gap or something similar to that? Why do we need to have a fair value gap or well, a fair value gap to make any fair value area valid? So mitigation block, a break block, or an order block. And the reason for that is because it shows intention. So sometimes we will not have a fair value gap and it will still hold. But overall, the higher probability order blocks, the higher probability mitigation blocks and break blocks, they have fair value gaps. It gives us more accuracy as well, because otherwise we are using a big order block, a big mitigation block, a big fair value area, and the accuracy is a little bit lacking right there. So hopefully that makes a little bit more sense as well. And from my experience, from the data actually that I gathered very early on, the fair value gaps that are being created off of order blocks, etc., they are a lot higher probability. Now, right here, if we take a look again at all the PD rays that we have, so we mark out every single PD ray. This is also becoming a swing high after today right there. So then after we have this swing low as well right there. And if we mark out every single PD ray, then we will see that we are now running into this fair value area right there and into the fair value gap that we have sitting right there. The 4 hour actually was also quite interesting. It's going to be a lot of lines, so hopefully it's not too confusing. We had, let me actually check. I had it ready already. Let me see actually. Yes, here. These were all the PD rays. Let me delete everything else actually. Let me add them later on. These were all the PD rays that we had marked out right there. And on the 4 hour, we saw this previous candle high, previous candle low right there. Then we had this previous candle high on the daily, which is a swing high on the 4 hour right now. Then after that, we could have also marked this one out right there. And then we had the fair value area with the fair value gap as well in the making, which at that moment in time is a little bit lower again. Then what is this? This is a nested order block sitting right there. Then this was the previous day low. So we can also use that order block. Let's just mark out the swing low right there. And now let's study the delivery. And what I mean with the delivery is we can already tell the delivery a lot of times by just looking at the simple candles. So this candle is very interesting right there. But why is that candle interesting? Well, actually, let's dive into it a little bit deeper. Because if we look at the 4 hour, then by just mark out the previous candle low right there on the 4 hour, we see that we sting into that previous candle low. We sweep it essentially because this is a respect of the previous candle low right there. After that, that gives a clear indication that we might want to trade into the previous candle high. All these things, if that is a little bit confusing, we're going to go over this fully in depth in the next coming videos as well, so don't worry. But after that, we see again that we now reach for that swing high right there. Again, a huge wick. A huge wick is, as a general rule of thumb, a huge wick is a respect. It's respecting a PD ray in that sense. Then afterwards, we see that we do not respect the previous candle low right there. So then again, the delivery towards that daily fair value gap right there is quite clear. After that, we continue lower, no audio here. Let me see really quick. Right, nice. So right here, if we then take a look at the next candles, then every next candle right here is just constantly closing below those previous day lows, which indicates that we do want to indeed continue lower as well. So the reason why we have marked out every single PD ray right here, then it becomes a little bit more simple, easier to understand, to see the delivery towards those PD rays and what we are doing with those previous PD rays, because then we can see delivery towards the next PD rays as well. So afterwards, this current area is really interesting because right now we have the same scenario where we are coming into this PD ray. We have previous candle low right there, previous candle high right there as well. So what do we actually want to see? Well, we want to see some kind of respect if we do want to continue higher right here of those discount arrays. Now, there is a very specific thing on why we can already somewhat expect lower prices here. At least I mentioned this in the forecast. You do not necessarily need to go watch the forecast after this, but I mentioned in the forecast that lower prices here would not be too crazy to me. And the reason I state that is because we are coming into a fair value area right there with a lot of momentum. And fair value areas in itself, they are great to use. For example, this fair value area, that's again great to use, but we will not always come back to fair value to then continue higher and repeat that process constantly. That's just not the case, because that's very suspicious, because eventually the more time runs, the more time passes by, essentially, the more fair value gaps we will create underneath fair value areas, the more liquidity we will generate as well. So what I mean by that is this itself is a fair value area right there. Usually the first time around, maybe the second time around works great, the fair value area right there. But if we then have a new fair value area and we can again continue higher off that, and then again a fair value area, price does not move like this. Why? Because eventually price will do something like this to then continue higher. And the reason for that is because the more time passes, the more fair value gaps on the higher time frame are being created underneath those fair value areas right there. So that is again what we have to take into account, that the more fair value areas we are offering, the more suspicious it is, in my opinion, especially without a clear drawn liquidity like we have on all-time highs right here. Then price eventually should just take off. It should just explode higher, not offering any fair value anymore until it has a big retracement. So this daily candle will tell us a lot on what we want to do. Now, before we look at ES right here, there's not too much to say right here. We would have to wait for equities open a little bit as well at 9:30. I want to go over a few more examples on the dollar right here. Now, you will notice that the dollar right here is a little bit more difficult to navigate. At least, in my opinion, is a little bit more difficult to navigate. So if we take a look at the monthly first, the monthly is quite easy to understand. If we mark out every single PD array right here, we have the fair value gap, then we have the previous candle high right there, then we have the previous candle low right there, then we can mark out another PD array. And this is not a PD array in itself, but this is a potential PD array. And the potential PD array I'm talking about, which already failed to be created, is a fair value gap right there, which oftentimes people do not look at. But at this moment in time, we can create a new monthly fair value gap higher right there if we stay above that line. And that indicates to us, if we create a monthly fair value gap higher, that there's some bullish intention potentially right there. If we do not create that, then we have more arguments to actually continue lower, because we have a lack of a new fair value gap created higher. Now, right here, we see we trade into that line right there, which that line in itself is not a PD array. So I would not go ahead and use that as a sort of support and resistance line. No, it's not a PD array. It's just an indication that we are failing to create a fair value gap higher. Then right here, based on this candle, what are we again doing right here? Well, we are respecting something, because we now have this PD array marked out right there. And we are respecting that PD array, that fair value gap, by looking at this wick. So now it becomes very interesting, because now we have two choices. Either the direction is towards this low right there, or towards that previous candle high. So the drawn liquidity is again either that high or that low. So which one is the higher probability drawn liquidity right now? Well, that is where we have to look at the previous candle. And the previous candle right here, to me, indicates that we are looking at that previous candle low as the first draw on liquidity. Now, can we be wrong about that? Yes, for sure. Because right now, if we trade back above this previous candle high right there, then that indicates that this fair value gap is not holding right there, which also indicates that the next premium array we have above that is actually this swing high. That is what we then call a domino effect, where a domino effect is a last line of defense. And if you know last line of defense, it's not a last line of defense that I'm referring to as in the flood and lot concept that we might use, that you've seen on YouTube or in the enrollment already. But it is a last line of defense as in if this rejection right there fails to continue lower, fails to push lower, then everything will fail right there. Because after that, we have nothing holding price back anymore from potentially rejecting to actually continue lower. So that is the last line of defense. It's sort of a do or die situation right there for price action. Now, if we then go into the lower time frame, then ideally what we want to see is we want to see fair value gaps actually supporting the idea of continuing lower, which currently we do not have, which is why I mentioned the dollar right here, the price action overall is a little bit more difficult to navigate. So we have to work with short-term trading conditions. And what I mean by that, short-term trading conditions, I'm not referring to short or bearish conditions, essentially. I am referring to the short time span trading conditions. So if you are looking to trade in these conditions, for example, you would want to have a short trade, as in short time span trade, very quick in and out, because it's just not in trending conditions. Trending conditions is just simply moving towards one side of the market overall. Now, what do we actually see right here if we again mark out every PD array and also the past PD arrays? Then we see a previous day high right there, this previous day high, which is also above that is a swing high sitting right there. After that, we have this new swing high sitting right there. We have this previous candle high, previous candle low. Then we have this swing high right there as well. And again, will I in every forecast mark out every single PD array right there? No, I usually don't do that because it's already quite clear towards which PD arrays we can actually navigate towards by just looking at the chart for me. But if you're just starting out and just start to use these PD arrays, it's very beneficial again to see those PD arrays and how we can actually deliver towards it. So right here, I would argue we came very close towards that previous candle high right there. But if we study the price action a little bit more, then right here, we see this swing high. The swing high, we are again respecting that swing high. After that, leaving for that Monday, which is the previous candle actually, at this moment in time, a pretty clear draw on liquidity, which is the previous candle low right there. All right, after that, what can we reach for? Well, what is the next discount array right there? Is this swing low. Well, what is the next discount array after that if we want to reach that? This swing low, and then that swing low right there. So in between those targets, we are constantly looking, all right, where can we have then the next run on liquidity, the next run towards the next PD array. So now all we need to figure out is if we actually want to move towards those discount arrays right there. There is a higher probability that we will move towards the discount arrays right now. Why is that? Because we are respecting premium arrays and we are disrespecting, we are closing below right there, those discount arrays right there. Now, how do we want to confirm that? We want to see fair value gaps actually going lower. So on the daily, we do not have any daily fair value gap going lower currently. So on the 4 hour, do we have any 4 hour fair value gaps going lower currently? Well, we had one right there, which does make the fair value area that we had right here valid. But ideally, what we want to do is we want to wait for a new fair value gap continuing lower that we might currently be creating right there to then target those lows again. So right here, the reason why I wanted to show the dollar and not just ES is because ES was great price action in itself. And the dollar right here is not great price action in itself. The dollar actually is very difficult price action to read. So if you find it difficult to read the dollar currently, that's perfectly normal because it's more difficult price action as well. So this is exactly how we can get to an early draw liquidity and how we can understand where it potentially wants to move towards next, the very basis of it. Again, tomorrow on Wednesday, we will dive into this deeper. If there are any questions, then feel free to, again, let me know on this topic and on the previous educational video. And then we can move on towards the actual live session as well. All right, let me see on the dollar right here. Let me also go ahead and remove everything right there. It becomes a bit messy when you mark on every single PD rate. Let me see if we have any questions. Let me wait for that as well before we actually move on. It shows the fair value in this 4-hour dollar chart. Yes, for sure, for sure. So the only fair value that we really had was this one right here. That's the breaker right there. It's the only one we currently have right there. After that, if we now continue lower and we create a new 4-hour value gap lower right there, then this becomes a new fair value area sitting right there, depending on if this is overlapping with a fair value gap or not. Ideally, this 4-hour value gap is ideal because that tells us a lot, again, where we want to continue lower from and how we can deliver there as well. If we can study the previous fair value areas a little bit as well. So previous fair value areas, and just purely based on the 4-hour, let's see, this is a previous 4-hour fair value area right there. After that, we continue lower. We have this one right there. And you can probably see as well, this is great practice to see what leads to consolidating price action. Consolidating price action, and this is already a little bit more advanced. I'm trying not to get ahead of myself, but consolidating price action is seen through fair value gaps and ultimately as well fair value areas not following through. And what does that mean, not following through? We are not creating new fair value areas off of previous fair value areas right here, where all we are doing is constantly sweeping previous fair value areas and not creating new fair value gaps lower and fair value gaps that actually tend to hold right there. If we look at any fair value gap that is sitting here, which one is the last fair value gap that actually pushed price lower with a new fair value gap? Well, that was actually this right there. And when that happens, you can see how beautifully the fair value area gets respected as well. And when that does not happen, for example here, the fair value area does not get traded into perfectly with just a wick to then continue lower. We create a bullish fair value gap. That bullish fair value gap fails to continue higher. Create a bearish fair value gap, fails to continue lower. That leads to consolidating price action. And that is an extremely valuable skill to understand because that will avoid a lot of loss as well. All right. When we dig past the fair value line, can it still react to a PD rate that is lower, or is it most likely looking for opposite liquidity? That's a great question. And when we dig past the fair value line, or we move past, for example, right here, when we move above the fair value line right there, then in itself, it can still react towards a PD rate that is sitting a little bit higher right here. If we had any clear PD rate that was sitting right there, it can still react off that to continue lower. So moving above a fair value line or moving below a fair value line in itself is not necessarily a bad thing. As in, it's not a how do I say that properly? It's not a deciding factor on if we will reach for opposing liquidity immediately. No, that's not it. But that's where we now have to go into the overall order flow direction, which is a video on Friday as well. Because if we now start to confirm order flow right here, going into that fair value area, which is already a little bit more advanced, so hopefully I won't confuse you here. But if we create this 4-hour value gap right there, and we create a new 4-hour value gap going higher off of that, then just a 4-hour value gap alone can also be manipulation. So how do we confirm if it's not manipulation? By a new fair value gap higher, because that confirms order flow direction. So that would then indicate that we can actually look to continue higher and target the opposing liquidity. But if we do not have that and we just have this move higher right here, then we can still look to continue lower overall. So that's it. That's mainly it. We will dive deeper into that as well with order flow direction. So hopefully that makes a little bit more sense. Let's see, so you can use the previous candle highs or lows as context instead of fair value gaps as you did now in the dollar. Yes, you can. You definitely can use the previous candle highs and previous candle lows. Where you want to use previous candle highs and previous candle lows is also something we are going to go over in coming videos, but after that as well. So trading every previous candle high and previous candle low as context is doable. Would I advise it? Not necessarily. So where to exactly do that, where to trade the previous candle highs and which ones, more specifically, is also something we are going to go over. But yes, for sure. In ES 4-hour chart, would you say the recent fair value gap is no longer being respected because the down candles have gone through the entire fair value gap? Let's see. On ES right here. Yeah, so we can get to an early understanding. And again, we need to wait for equities open right here for ES. But if we remove the time aspect, and the time is something we are going to go over later on. It's not something super relevant in the analyst phase. We will go over it later on in the analyst phase as well. But if we remove the time aspect here, then I would argue at this moment in time, we are disrespecting these 4-hour fair value gaps going higher and that daily fair value gap going higher as well. Early signs again. And why do I state early signs? Early signs are sort of when we wait for a candle close, when we wait for a daily candle close, then that takes a whole day. Obviously, that takes 24 hours. So we ideally want to find early signs because then we can still be a part of the move already continuing lower, if that makes sense. So the thing right here is that if we wanted to continue higher, we already came into this fair value area with this candle right here. With that candle right there. This candle had a nice rejection, actually continuing higher. Does it need to come into this order block? Does not need to, because this is already the fair value area. So take that into account that we don't need to. We can do that and we will see how we reject right there, but we don't need to. So right here, the ideal thing we want to see for the next candle is a continuation higher, as in at least an up candle, somewhat of an up candle, because we already have a rejection. So after that, when we then start to follow through higher right there, that indicates to us a lot already that we might not actually want to continue higher. So to answer your question, very simply said, yes, we can indicate that this is not being respected and that this definitely is early disrespect as well. Let's see. So all this big consolidation in the dollar become a bigger fair value area and we must wait for expansion in price in some direction. Yeah, essentially, yes, this is all one big fair value area in the making right there, and the high probability happens after, not currently, if that makes sense. Eventually, the fair value areas have to start failing, can't be pushing higher for much longer. Full margin short ES and Nasdaq. Yes, that is the idea. That is the idea. Let me see. I'll go over that question in a little bit. From this Mino. Let me see. Candle close inside of a fair value gap is disrespect. Close below 50% of bearish fair value gap is total disrespect, is going lower. Yes, that is general rule of thumb. I like the general rule of thumb as well. And I mentioned it in previous enrollments as well. It really depends on the overall context though. Really depends on the overall context. But that's a great general rule of thumb. For sure, for sure. Let me see. Exactly. Perfect. Perfect. We see if we have a few more questions before we move on as well. Don't want to miss any questions. This is a great question. When we identify a PD ray in a higher time frame, we must duck into the lower time frame for PD rays overlapping. No. When you already have a PD ray, so by this, in this case, we just had a 4-hour fair value gap or 4-hour nested order block right there, which usually tends to happen as well. But you do not need to go into the 4-hour right there to scout for a PD ray higher right there, where we do not need to go into this 4-hour order block, for example, to now find a 15-minute nested order block sitting right there. That becomes very confusing, becomes a little bit too much for my liking. Again, depends on the trading plan overall, which we'll dive into in later videos. But once you find the PD ray right there that we can continue higher from, we can continue lower from, that's all you need. You don't need to find the overlapping PD rays on the lower time frame. The fair value gap as well, I'm not sure if I mentioned that actually. The fair value gap, of course, we want that as well to be on the same exact time frame. So if we do not have a fair value gap on the same time frame, then the fair value area is also not relevant. If that makes sense. Let me see. But there's also a chance the current 4-hour can actually reject the downside with the volatility at 9:30 open, and this is where we eventually respect the fair value area. Let's see. Yeah, for sure, that can definitely happen. That can definitely happen right there. That's why I mentioned as well, right here, the 9:30 open is very important, and I do not necessarily want to dive into the time aspect just yet for the spring enrollment. So ignoring time, we can definitely get to the conclusion that we already want to continue lower. But incorporating time, it's a whole different story again. So I want to incorporate time later on. Which one should I give a more priority to, a fair value gap or breakaway gap when in a favor fair value area? Well, that really depends on a lot of things. In a fair value area, you ideally want to, doesn't really matter if this is a breakaway gap or fair value gap in this sense. You want to pay attention to the fair value gap that's overlapping with the fair value area high or low. That's the one I would advise. Let's say on a daily ES, the fair value gap would have formed above fair value area, so they do not overlap. How will we approach that? Say on daily ES, the fair value would have formed above fair value area, so they do not overlap. You mean if this right here, if this wick would have been like this, for example, then it would have been a whole different story, because then we would have already had an indication that we might want to continue lower even earlier. And what I mean by that, again, is when we have a situation like this, where the fair value gap is not exactly overlapping with the fair value area, in that sense, that already indicates that we have less momentum going higher. Especially after a sweep like that, we have a lot of momentum going lower, actually. So if we want to continue lower, then we already have extra arguments continuing lower right here. Now, then we still have this daily value gap that we need to overcome, but we have a lot more, again, a lot more arguments to make to already continue lower a lot right there. Where if we have now the fair value gap overlapping, this is essentially just a perfect setup because we have the perfect bullish intention. So it changes the story a little bit in the sense that the overall bias changes a little bit, if that makes sense. I live in USA. By the time I get up, most of the move is complete in London session. What time is good to trade in New York session Forex? Yeah, the New York kill zone, so New York session itself is good to trade from what I noticed myself personally, since I've also been in Colombia and I'm also in New York local time. Forex is a lot more difficult to trade because we missed that London session. And for Forex, London session is almost, well, I wouldn't say it's a necessity, but it makes it a whole lot easier to trade London for Forex. And what my advice would be is if the time allows you and you can trade New York session, then look into a flow trading plan, so into the lower time frame a little bit more. Or you want to go to the extremes, right? So either a very much higher time frame where you can just execute at any time you want, or lower time frame where you go into the 1 minute time frame for a flow trading plan. And my advice again would definitely be look at indices and futures overall. They could be very interesting as well. Definitely something we'll dive into later on as well. Let me see. Let me see one thing really quick as well. All right, I will stop this recording.